Welcome once again, everyone. It is our pleasure to have the Governor of the Central Bank to deliver the keynote speech today. Firstly, thank you, Governor, very much for taking the time out of your very busy schedule to be here today. Before we begin, I would like to remind everyone that there will be a 15-minute question and answer session at the end of the session. So please send in your questions to the Capital Alliance account, and we will direct them to the Governor to answer. So without further ado, here is your keynote speaker for today, Dr. Nandalal Weerasinghe, Governor of the Central Bank of Sri Lanka.
Good morning. Thank you very much for inviting me for this important forum on the first day as a keynote speaker. I think in my remarks at the beginning, just to in line with the theme of the seminar, which is Restart Sri Lanka, let me just take stock of where we are now, and then I'll talk about immediate kind of challenges or steps that we need to recover the economy back to normal path, and what are the medium to long-term important reforms and policy measures, especially when it comes to, mainly I will be focusing on the central bank side, the monetary policy, financial stability, and obviously debt restore and sustainability, those areas. And I'm sure tomorrow the minister will focus on the mainly more detailed fiscal, revenue-based fiscal consideration, fiscal policy. So let me start. First point I would like to make is that compared to last year, when we announced the standstill in April, when we had almost zero level reserves, exchange rate was floated without any safeguards, was going like the kite which is going without control, and also the inflation was rapidly rising, huge monetary expansion, and printing money by the central bank, which was leading to hyperinflation. An economy was going to crash, and basically crash landing. So what we did, was that economy was able to have a smooth landing without being crashing. For example, at that time, the fear was, even the IMF prediction was that economy would contract by 8.7% by end of the year. That was the most most conservative estimate that we had, but we ended up by 7.8% contraction. And the inflation was projected to come to single digit by end of 2024 in the IMF framework, but we were able to bring down the inflation to single digit by end of July. So much better performance. Also in terms of zero levels of usable resource, have been able to build up over 2 billion of usable resource, while meeting some of the debt obligations by the ADB, World Bank, monetary agencies, and some of the resource that we have been able to sell some of the subs to the Bangladesh as well. So in terms of, and also financial system stability, there are also stress on the financial stability in terms of rising NPLs, banks' exposure to the sovereign debt, both domestic debt and as well as external debt, ISB holdings, and foreign currency obligations. So with all that, so right now we are in a position that is much better than what was predicted. This was as a result of very tight monetary policies, very prudent financial system stability measures, and also together with government fiscal policy, much stronger and very strong fiscal tightness program and fiscal discipline that was brought in, together with some of the structural reforms that we have already implemented. First one is the new Central Bank Act will be enacted soon, and Bank Sector Social Provision Act that has also been passed to meet any eventual financial system stress. That's one of the important ones. And also there will be new Banking Act from our side. And on the government side, anti-corruption bill and the social safety net, supporting poor and vulnerable, all these things have happened. As a result, we have in a much better position. And also almost completion of domestic debt optimization. Part of the next important step to complete the both to restore the sustainability or medium to long term. And for that, there are two parts. One is domestic debt optimization. Unfortunately, there was a delay more than expected of the completion of DDO, although we announced and Parliament approved this on 1st of July. There were several petitions in the Supreme Court against both the DDO design and proposal, and as well as the tax amendment, that Coalition Funds tax amendment. But we understand now, yesterday, Supreme Court has given a positive determination that can be, so that Parliament will be able to approve the tax amendment in the coming week, so that we should be able to complete the domestic debt optimization program within this month, most probably within the first half of this month. So that's completion of that is a most crucial step in the short term on the restoring debt sustainability, especially restoring domestic debt sustainability in terms of providing government a huge relief in debt service payments in the next 5 to 10 years. So that part will be completed soon. And the next important step is to continue negotiation with external creditors, both through official coordination committee, which is chaired by both India and Japan, together with Paris Club, and also this negotiation with China. We are making good progress there. And what we are hoping is to complete and come to an agreement or understanding on domestic external debt, especially official bilateral creditor engagement, come to an understanding within this month or at least within next month, so that we have sufficient time for the IMF to complete this next review sometime, perhaps in October, November. For that, the mission is coming in a couple of weeks next week to assess the situation and also negotiate or discuss the next wave of reforms, structural reforms, as well as quantitative targets in terms of resource inflation, because inflation we already achieved, so we had to maintain price stability continuously, and also a level of resource and revenue targets, fiscal targets, and also structural reform. That process will begin when IMF mission is here next week, so that we will have understanding before the next completion of next review, what are the policies and measures that we are going to commit under the program for the year 2024. This is the process, and hopefully we should be able to complete all this process so that IMF can disperse the second disbursement tranche somewhere in November. That is the timeline that we are planning. I think I am quite hopeful that we should be able to complete, despite some of the delays on the DDO that all have been now cleared, so we can move ahead with that. So those are immediate short-term steps in the process of recovery of economy. On the economic recovery, what we see, especially there was contraction of the economy during first half. Q1 was 11.5% contraction, and Q2 probably much lower contraction. And what we expect second half, contraction will be, and there will be no contraction, there will be positive growth compared to last year. But overall, still this year, economy will be kind of a small contraction compared to last year. But this whole idea of stabilizing economy and basically having a strong foundation for the economy to grow faster in next several years on the medium to long term is the whole idea why we are having this economic stability, macro stability first, and then on that base, on the foundation, we hope that economy can take over, grow at a much higher rate than envisaged by the IMF macro outlook, that also probably would be revised based on latest performance. And I would say one thing on the medium-term macro outlook, that there's an argument that's just to make some of the doubts clear. What we have seen in the arguments is that under the IMF program, economy is expected to grow only about 3% in the medium term. This, I would say, is a conservative estimate, to restore the sustainability. It does not mean that economy will have to grow at only 3%. And also, some of the debate about the IMF program is that there's no program to grow the economy, the expand production of goods and services. That is none of IMF business. I think that's what I want to make it clear. IMF program is all about economic stabilization and restore macroeconomic stability. The economy, for us to make the economy grow at higher rates than the baseline scenario, it's all about our policies, both the parliament, cabinet, government, and the central bank. If we implement growth enhancing reforms, if we make easier for people to do business and address all the structural bottlenecks and reforms, obviously country can grow faster than 3% on the medium to long term. And we have seen even in the past with all these issues, economy had been able to grow around 4%. I don't see any reason why we can't grow around 4 to 5% in the medium term. So that will be a overperformance, as you already seen, and we have already delivered overperformance in terms of inflation, in terms of external reserve buildup, in terms of movement of currency, exchange rate, all have been overperformed. And also in terms of financial stability, that's also we are overperformed. So already we are saying we are able to overperform than the baseline scenario if we do things right. And also on the other side, if we deviate away from at least from the baseline scenario of the certain policies and directions that we have agreed and we have committed in the medium to long term, then obviously we can again go back to the same situation. For example, if you look at the commitments that we have made next 4 to 5 years, medium to long term commitments under the IMF program, there are 5 pillars. First one is on the fiscal side, revenue-based fiscal consolidation, fiscal structural reforms in terms of fiscal public financial management, fiscal discipline, fiscal rules, budget office, all these things, plus also important part, protect poor and vulnerabilities. That is the social safety net. Who affect our poor, they should be protected also through the impact of worst economic crisis. That is the first pillar. Second pillar, restore public debt sustainability. That is why we are talking about all this domestic and external restructuring, that we are well on way to restore the sustainability. Third pillar, restore price stability, which is inflation stability, and rebuild external resource. As I said, we have already overperformed in that area. And fourth one, safeguard financial stability, which is a stability finance system. The way we design the domestic optimization and external debt restructuring, which main bottom line is to protect financial stability, we have been able to achieve that as well. Now banks are moving in to support the growth of economy, expanding credit, going forward with the interest rates coming down and with inflation stabilizing. And fifth pillar is an important one that in this program is to reduce corruption and vulnerabilities and growth enhancing reforms. That's the fifth pillar, under which we have already seen government has passed anti-corruption bill. There's a private commission has been strengthened. There's new laws are there, and growth enhancing reforms are on the structural reforms in the state-owned enterprises and other medium to long-term labor force, more participation of female labor force in the workforce, and address labor market reforms, address land reforms. All things are other important reforms that has to implement going forward to recover and restart the economy to grow at a faster rate than any such or predicted by the IMF to restore the sustainability, which means if we can outperform, we can restore the sustainability much faster than the anticipated or envisaged in the program parameter. That is the whole idea that we want to restore. So the downside risks, obviously, what we have to alert is that what we are seeing a lot of debate. And before that, let me address another thing on the domestic debt transaction. We are seeing some of the misperception by some of the politically driven people about the treatment, which is DDO is unfair, unequitable, and only the superannuation fund people have been affected. This is misinformation. This is where all Supreme Court cases that all refused to leave, so that we have been that has been justice. So here the idea is that if we don't maintain financial stability, superannuation fund members 2.6 million also will be affected worse. And this is to protect for them to have they continue to have a concessional tax rate of 14%. So there's a small contribution, which is not as significant. That is ensure first all balances of the EPF will be protected. There will be no reduction of member balances on behalf of the EPF, I can assure, as a general government report. Secondly, their balances, what remains in their balances, will at least minimum will be growing at 9%. That's assurance by the government that they will support to assure 9% growth of their returns every year in next several years. So that's second assurance, which means that will protect the members' balances as well as that protect their return that they have received last several years. So that's important assurance that will protect the balances. If not, if the government is not in a position to service their domestic debt, which is very high, then the impact would be worse for EPF members as well as all the bondholders and the country and the banking system. That is, this is the best design and most fair treatment for everyone to protect their stability and their bank balances in the banks. Depositors were concerned some time ago they will be losing their deposits, so we have assured that there is some stability. That's one point that I want to make. And going forward, the risk to the path that I was talking about is that anyone who is, whatever the administration, current or future, need to ensure that we move in the same direction. And the 5 pillars that country has committed to restore and restart the economy, all 5 pillars: revenue-based fiscal consolidation, the sustainability, price stability, financial stability, building resource, and reduce corruption, vulnerabilities, and growth enhancing reforms. If anyone argues that there can be a different path, like we've seen sometimes, see that we can do something differently and have homegrown solutions, then obviously people will have to be very alert on that. But I would like to express the view that anyone who is talking about deviating from this path, certainly that will be a deviation from the path that there's a risk of moving back to the earlier positions and worse situation if we are not being able to move in this very narrow, stable path. Any deviation could trigger a difficult situation than what we envisaged last year. That is something that's why we all need to understand. And it's important to have public awareness of importance of the direction that economy is being taken and all the fronts: monetary policy, fiscal sustainability, growth enhancing reforms, the addressing corruption vulnerabilities, and so safeguarding financial stability as well as protecting poor. If anything, a deviation from this path, that would certainly risk going forward. And also there could be some external risks that we can manage. For example, now the monetary tightening of the global advanced economics, that could have some impact on our export demand, but there are certain instruments we can deal with: domestic policies, exchange policy, the monetary policy, and demand management policy. We can manage those things. Domestically, we have instruments to manage that. But we have to ensure we are moving in the right direction, and we will not go back to a crisis that we had, like, not to again the measures that will stress on the debt levels of the government, sovereign debt, and that will stress balance of payment situation and resource going down. In a situation that will stress more inflation and monetary expansion, money printing. If you're going to go back to that kind of situation, obviously that will have to be highlighted by the people, markets, and stakeholders economy. That's why it's important to ensure that we are moving in the right direction. Those are the initial remarks that I have, and obviously one thing I want to announce is that basically one thing on the monetary policy, as our that as I said earlier, we have been able to bring down the inflation. We have been able to stabilize the currency that was floated without any safeguards, that we had a lot of controls, and we have been able to stabilize the situation. But going forward, inflation has come down to single digit. We are also been loosening monetary policy. We have been going into we are relaxing the very tight monetary situation that we had, and we would also expect the benefit of monetary relaxation should be passed to the borrowers and people who have credit and people who are under stress, especially SME and other sectors. That's why we issued this circular to the banking sector. They have already interest rates are already coming down in line with the monetary kind of monetary relaxation, but we would expect that it's better to accelerate that process, bring down the interest rates in line with market rates sooner than later. That is why we had to issue this temporary kind of circular that would facilitate and give some guidance for the banks to bring down interest rates in line with monetary policy. Going forward, even monetary policy should be further relaxed given the inflation and interest rates, policy rates where they are. So we would expect interest rates to normalize sooner than they will be. Banks are now stable. They should be able to support the economy through expanding their credit operations at reasonable low interest rates. And one of the uncertainty that we had was a domestic debt optimization, which had some uncertain premium on government security yields. Now that will soon be addressed with the completion of DDO. So with that will help decelerate the kind of reduce the interest rates faster. From this month onwards, we should be able to bring down interest rates to much reasonable and lower levels in line with inflation and multiple taxation. That is the reason that we announced this, and we hope that banks will follow suit, and otherwise we will take certain actions. If rates are not coming down, we have certain instrument to deal with that going forward. With that, let me stop here, and I'm happy to answer any questions or clarification. Thank you very much.
Thank you, Governor, for providing us with some good insights on how far we have come, the short-term strategies for economic stability, and also in terms of the steps for economic recovery in the medium term. I will now open up the floor for questions. As mentioned, please send them in on the chat option to the Capital Alliance account, and we will direct them to the Governor. So to start off with, Governor, we have got two questions, and I think we can combine both of them. There's a question in terms of further monetary policy easing. So there's a question from Ruchir as well as from Templeton with regards to the fact that inflation is now down to 4%, and also that private sector credit growth has reduced from 74 billion to 13 billion in July 23. So can we expect any further monetary policy easing as a result of these two factors?
Yeah, in fact, monetary policy is data-driven, the forward-looking policy. And if you look at current data and the outlook, we certainly are very confident that we will be able to maintain inflation in our target range, mid-single digit, which is around 4 to 6%. We are actually the low end of that band now, but it will further go down and it will stabilize around 5% next year. That's our prediction. So if the inflation is going to be around medium to long term 5%, that is our objective, then obviously we don't see why policy rates should remain at this 12% level. Obviously, once we see the things markets have settled, then interest rates, certainly policy rates will be coming down going forward. But it's difficult for me to give timeline that all because driven by data and empirical evidence and also outlook that we see. So that certainly there is a space to relax monetary policy further, even in terms of policy rates that you can see. And also given our guidance for declining interest rates, that's one of the reasons I see why credit is not expanding as fast as what we think. because people who are still repricing their earlier, kind of borrowings, settling their loans and repricing their new reduced interest rates, and also wait and see approach, because there's downward trend in interest rates. People wait until interest rates settle down to a certain rate, start growing their credit, start borrowing new. That's why we don't see a fast recovery in credit in the last 2 months. But I would expect that credit growth will come back within this year, in next several months, in the growth territory, and that will also support the economic growth as well, and with interest stabilization. That's why I think obviously there's a space for the monetary policy when you look at current situation and data and the outlook for inflation and growth. Because growth is still below potential, and inflation is within the target range, and policy rate should be coming down further. So.
Thank you, Governor. There's also a question from Andrew Lyman, which states, could you please outline your assessment of the risks posed by the drought conditions in Sri Lanka?
Yeah, drought condition obviously is a very short-term impact as far as we can see. One is now this, there could be a supply side small impact, especially on the food side, and supply of, say, rice, all this, some of the food items. But good part of this is that food inflation is in a negative territory. We have space to manage that kind of a short-term shock. And also other instrument that we can deal with that is to, now with the imports stabilizing, we have already relaxed a lot of imports. So any kind of a short-term supply situation can be managed through opening up for imports, so that prices levels or any sharp increases can be managed in terms of supply side. And obviously, even if you factor in certain kind of a short-term supply, I think still that in our inflation projection, we have already factored all these things. But still, we are confident that we can maintain inflation. And obviously, there will be some production losses in terms of agriculture production. It is only 7% of GDP. I think in terms of GDP, that is not going to be a huge, because the contribution of agriculture production is only 7% overall GDP. It's mainly industry and services are driving the growth. If the recovery in tourism, remittances, and other business areas, services, we still can move into a positive growth territory. I think we can manage the situation. And already we can see rains are coming back, and hopefully the situation can be normalized even before it's having an worsening, kind of a negative impact in the near-term growth and inflation.
There's also a follow-up question to that, but I believe you've already kind of mentioned a little bit about it. With regards to the drought conditions, in terms of your growth as well as inflation expectations, how does this affect it? And also, does that mean that there is going to be an impact in terms of how you look at monetary policy going forward as well, if the conditions continue?
As I mentioned, I don't think monetary policy should be responding to short-term supply shocks. That's a different way. There are different ways to mitigate and address, all these impacts on the growth and inflation, which is basically mainly from the fiscal side and government side. If we see a shortage of certain food items, we can open up, as I said, a market for imports, and can provide some support in terms of relief. And also, as I said, the agriculture sector is only a small component of the growth. I don't think that's going to be an impact. I don't think we certainly take into account and factor those things in our inflation and growth projections. We will make decisions, but not necessarily we need to respond to supply shocks in our interest rate decisions. It's a short-term supply shocks. I don't expect that to persist for a longer period.
Understood. There's a different question in terms of the reserves from Olivier Duguet. Says, can you please disclose the current level of central bank foreign reserves, and at what rate do you expect the recovery in these reserves to go?
I think we have announced, if you look at the presentations that we have made in terms of reserve path, in present we have made in terms of external finance, what is the regard external financing gap we had to, and also levels of reserve we had to build up over a period of time. What we can say right now, I think we have a 3.7 billion, right? 3.7 billion the gross reserves, of which 1.4 billion is Chinese stock, which is 1.4 billion. So then we have about another about 2.3 billion usable reserves for the time being that we have built up, which is more than what we expected. And going forward, we have a commitment for a reserve target for this year. We will be able to meet that target. The next year, based on the medium to long-term reserve path that we have agreed, I think over a period of time, so this assembly, we build up reserves up to 10 billion by I think 2027 or 2028, based on the DSC analysis and external financing gap. That's where we have to build up for a period of time. But next year, on the basis of we are going to discuss and indicate our risk level reserve. Obviously, from our side, we are committed to build up our resources, and that is why we negotiate this regulatory structure in terms of that our debt service burden would be limited to 4.5% of GDP in every year within the next several years, so that debt burden would not have impact on the building up of resources. On top of that, we want to build up resources through several other means in terms of exports, remittances, other portfolio inflows, and also IMF, World Bank, ADB, some of the concessional loans that will support the economy as well as to build up resources. And obviously, the ADB, World Bank, under the program, there are commitments about over 7 billion commitments of program financing, that is cash support to the government that will help for us to build up resources. In addition, we have commitment to purchase resources of foreign exchange to build up resources with right monetary exchange policy. So I think we are confident and we are well above the current levels, and we will be able, I'm sure we will be able to overperform if we move in the right direction going forward in terms of building out resources and making it much more comfortable going forward.
And a follow-up question to that, Governor, is at what FX reserve levels do the China swaps become usable?
As I said, 1.4 billion is a China swap out of 3.7 billion what we have now.
So it becomes usable after the 1.4 billion mark?
No, that will be usable after we have 3 months of imports coverage, which is about, I think right now, 1.4 billion monthly imports. 3 months of imports, roughly around 4 billion like levels. If we reach about 4.2 billion levels, I think then we should be able to utilize that as well for the support imports.
Sure. And also in terms of going further for commercial borrowings from the international market, how soon do you think that we can access commercial borrowings once again?
As far as when looking at the restoring the sustainability and looking at the financial flows without accessing the international capital markets, I don't think, and also given government would be able to generate 2.3% primary surplus, I don't see the need for government to go to access. I mean, even though access is open, access can be open quite soon once you reach certain levels of, if you overperform compared to the baseline scenario, the IMF, I think and also with rating, with the completion of debt restructuring, there will be an upgrade in terms of ratings, sovereign ratings. So that will open up the markets, depending on obviously global market conditions and our ratings. Difficult to predict when that will happen. That all depends on our ability to meet especially ambitious fiscal targets like 2.3% of primary surplus. I don't mean that even though markets access to markets, capital markets open, I don't see a kind of a need for the government to go to the market and raise as much as we raised last several years. Because if the government is trying a reasonable budget deficit, I don't see a reason why government should be raising commercial financing. as long as they have access to ADB, World Bank, other things, and also some of the bilateral project loans will be opened up once we complete the external debt restructuring, especially like countries on Japan, other bilateral export credit agencies, all will be opening up. So that with that, one thing is when can we have market access? It depends on how we perform. Based on the IMF prediction, they think we don't need market access until 2027. That's where they think in their baseline. If we can perform better than that, I think we could have market access even before. But the question is that whether we need to go to the markets and raise is up to the government, depending on their financing. I think if they can raise sufficient domestic resource mobilization through revenue and the at lower level of debt servicing, I am sure government should be able to fulfill their financing needs at the lower level of domestic resource mobilization through revenue and also financing, as well as some of the concessional and that kind of financial lines all the line up. So if the economy is going to grow faster, obviously there might be need opportunities, but I think and depending on FDIs and some privatization, diversification of assets, all these things also factor in. So we are hoping, I'm basically hoping that government may not need to raise a significant amount of external commercial financing going forward. And that will also ensure restore, maintain external debt sustainability going forward.
Thank you, Governor. On the external side, once again, there is also a question in terms of the Bangladesh swap and any further outflows that you have before the end of the year. Will Sri Lanka be settling the remainder of the Bangladesh swap this year? And also any import loans that have been taken by India, will that be settled this year as well?
This Bangladesh swap actually announced the central bank swaps are short-term central bank obligations. Those are not government obligations. That's one thing I want to clear. This is not government financing. These are central bank borrowings, short-term borrowings. And once we build up our resource, we should be able to settle all these things. So Bangladesh understanding was that will be settled within September and October. At about $200 million, we can comfortably settle that. We have settled, I think, a larger part of that, only a small part remaining. And the other central banks of SU liabilities with Reserve Bank of India is also liability of the central bank, with the Reserve Bank, that we are discussing how we can settle that 2.4 billion obligation for a period of time with the Reserve Bank of India. That's bilateral discussion going on. We have our discussion that we can settle over a period of time without much impact on the build-up of resource. That's the next short-term obligations. And on the trade credit, the credit facilities that government had from India during the crisis period, those will be serviced as per scheduled loan agreements. As my understanding is that those are not within a very short period. I think one petroleum facility will have to be settled within 1 year. Other is only $500 million. Other 1 billion credit facility for trade, emergency credit trade facility is, I think, as far as I can remember, government side is a 3-year facility that will be settled over a period of time based on the agreement. Those are not so big obligations, I think. Once the external debt is completed, those are outside the perimeter because those are short-term kind of the facilities those are provided at the time of crisis. Those will be settled, but we have factored all these things in our reserve path, and we have provisions to meet all these debt service obligations short-term, including 4.5% of foreign debt service obligation after the restructuring. That's also factored in our reserve path. I don't see a problem with that.
In terms of the debt negotiations, there's a question on, given that there have been some delays already in the finalization of the domestic debt optimization program, will it lead to further delays in terms of the external debt restructure, or are they these two negotiations independent of each other?
No, those are going parallelly, independently on the two lines. Obviously, it would be better that will give more confidence to the external creditors that once we fully implement the DDO, which is also part of the overall restoring the sustainability, two parts. Obviously, once we complete domestic tokenization, that will give assurance to the external creditors that we had done our part. And domestic debt is also sustainable medium to long term. Government who don't have financing, domestic financing stresses in meeting their financing the budget deficit going forward. That's an important one. Sooner the better, but it has no direct implication. I mean, there's not a sequencing that we have to do this first and then do other things. But parallelly, going and making progress on both sides would certainly will be beneficial, and we should be able to complete this thing sooner. And whole idea, as I mentioned earlier, is to get the first review completed somewhere in October, November. So we had to complete both parallelly before the completion of first review.
Understood. And in terms of the funding lines, will there be anything that is unlocked in terms of multilateral as well as bilateral funding that will open up after the conclusion of the DDR and possibly in terms of after the first review of the IMF as well?
Multilateral lines already open. This is where, if you look at the presentation, how we meet the external financing gap and government finance, sovereign financing gap is the responsibility of multilateral agencies is to provide long-term concessional financing to support the program, support the field external financing gap. That's why their debt is not restructured, but their obligation is to provide concessional financing on the medium to long-term basis. That commitment is already there. What we expect now, there's a global kind of understanding. Multilateral banks should contribute more towards the countries which are the debt stress in terms of providing more concessional financing. So right now, already we have commitments from both IMF, World Bank, ADB, very positive commitment, medium to long term. But we would expect with the global efforts, they should be able to contribute more, not only for Sri Lanka, but all the countries with low income and middle income countries that need external financing, they should be able to contribute more. That's why we expect even over and above already commitment, they should be able to contribute more on transnational basis. That's on multilateral side. On the bilateral side, once we complete the domestic debt, for example, in Japan, as a policy, they can't provide any additional financing even projected, and they have ODA assistance to countries which have suspended debt service payments. So once they complete the debt restructuring and have agreement, then obviously those lines will also be opened up. There's certainty on the Restart Sri Lanka bill, then obviously other bilateral official lines will also be opened up. And on top of that, once we complete and obviously the restructuring and ratings upgrade, then obviously private sector, credit facility banking sector, they had large kind of facilities, credit lines available before the crisis. And with the ratings that has been now dried up, but with the already there are credit lines opening up for the banking sector and private sector, the credit lines. That's another opportunity that our banks should be able to mobilize external credit lines to facilitate supply credit to domestic sectors and exports. Another part is the foreign direct investments. So once it's stabilized situation, we can see a lot of projects, both India, China, and like say renewable energy, the port related, the investments. Some of the projects in Hambantota, these are the other private sector external flows that can supplement the external, filling the external finance gap once they stabilize and have more confidence and with rating upgrades. There are several opportunities and lines that can be opened up when the economy normalizes to a situation that we had like earlier before the crisis.
Thank you, Governor. I think we have about 5 minutes left in terms of this session. Just the last, I think we have 2 questions in terms of the fiscal side. Are the fiscal measures that have been taken by the government enough so far to meet the IMF targets? Because the tax numbers do reflect as though they are quite low. And in terms of how it will be financed, what is the mix between the domestic and foreign financing of this budget deficit?
That's, I think, question probably you asked from the minister tomorrow. I think I can broadly give some guidance based on what in terms of fiscal targets, government have been able to deliver the primary surplus. In fact, for this year, the target is to deliver primary deficit of 0.7%, but my understanding is that already first half, there is a primary surplus. That is, the performance is better than expected. But there's a deviation or not meeting the targets, a revenue target for first 6 months. The reason being that the imports were much lower because the restriction, import duties and collection from the border taxes were lower. So what will happen in the second half? There will be some recovery from import duties and collections and value-added tax based on imports, because our imports are expected to recover during the second half. That will help certain measures. And also with the economy recovering, the value-added tax and income tax also perform better than expected. That will continue to perform better in the second half. I hope government should be able to meet the revenue and primary surplus deficit target for by end of December, so that review can go ahead. And obviously for the next year, government will announce in the budget what are the tax measures which will ensure collection of similar revenue targets as well as delivering primary surplus or deficit target for 2024. That's more of a question for the fiscal side than the government. I think this is what my broad understanding of the fiscal issues right now they have. And in terms of financing, obviously, the justice cycle DDO completion and external completion, there will be much relief for the government to meet the service obligation. Financing wouldn't be a major issue, especially with program financing coming directly to budget support from both IMF and World Bank, ADB budget support. So that money which is able to utilize to finance any budget deficit that is envisaged for this year.
There's also a question in terms of a follow-up on that. I mean, there has been quite a bit of raising that the government has been doing through treasury bills to fund the deficit. Will this composition change where the government will start moving towards borrowing more through treasury bonds in order to improve the gross financing needs and achieve that target set out by the IMF?
So the strategy, why that's our recommendation also, until we complete the domestic debt optimization, and with the very high premium on treasury bonds that we have seen well above the policy rates. For example, treasury bonds bills went up to 34% at some point. Treasury bonds went up to about 30%. So that is a situation because of the lot of uncertainty and premium factored into the government yields. So that's the best strategy. That time was to raise as much as all the high interest rates in shorter maturities, especially with treasury bills, because we didn't want government to have a longer term burden in terms of interest expenditure by raising more treasury bonds in a long term commitments to pay high interest rates. That is where recent last several months, a lot of treasury bond maturities were replaced as much as possible with treasury bills, short term treasury bills less than 1 year. Although rates are a little high, although declining, but that is a better strategy in terms of managing external financing and interest expenditure, which is very high at the moment. So with that strategy, until DDo's completion, we skewed and more focus bias towards facing from treasury bills shorter term liabilities, just to manage the future interest expenditure. And once we see the completion of DD, obviously there will be a much more stable medium to long term reasonable yield curve in line with our policy rates. Then obviously government will be back to raise, depending on their maturities and desire to extend the maturities at the low interest rate. Then obviously we'll come back to a normal treasury bills and bond issuances within the limits of the borrowings imposed by the Parliament. Once we complete the DDO pretty soon.
Understood. Thank you, Governor. And with that, I think we can draw into a conclusion on our first session for Restart Sri Lanka. I believe this sets a good base in terms of where Sri Lanka is heading, achieving the economic stability that it has so far, and also in terms of the steps that the governor mentioned in terms of where we're heading in terms of economic growth, and also a little bit of clarity in terms of future monetary policy as well. So thank you, Governor, once again for your valuable time and being with us today. So with that, I will direct it back to Dilushka to inform you with regards to the breakout sessions that you have signed up for individually. Thank you once again, everyone, and thank you, Governor.
Thank you.